Good morning. I hope you guys doing well and welcome to today's edition of the London Session Open. Today is April 9th, 2020 and it's a Thursday and it's almost 11 a.m. in London when we're doing this market update. I know we're doing this significantly later than usual. Reason for that, I had to sort out some things before I could join you guys. However, though, what is good today is that I don't have anything coming up just after this, which means that we can actually spend some time answering questions, because since the coronavirus crisis, as you know, the updates have been a bit shorter because of a bunch of meetings I have. But that's been sorted now, so we have more time together and we're going to talk about the markets. And we're going to begin just by looking straight into the German DAX. And by the way, if you are totally new about this presentation, we're going to look at the currency markets, some stock indices, and some commodities. And after that, if you have questions, you can just put them in the chat box, which is over here, where we have Stefan already and True Invention joining us, and also Basa the second. So if you guys want to join in, you can do it there. You can just say hello, even if you don't have any questions. That's always nice. And if you're watching the recording, don't forget to leave a comment. That's really important. Okay, good stuff. Stefan, True Invention, Basa, thanks so much again for joining me. Okay, so let's talk about stocks. So coronavirus situation has not changed too much. It's still sort of lingering around the low numbers we've seen lately, and the market continues its uptrend. Now, yesterday we said look to buy down here and this little spot here for this to go up. You can see we did go up, and we're now having a bit of profit taking. I think it makes sense to have some profit taking because this long weekend, you got Friday coming up, which is closed. We have also Monday coming up, which is closed. So people are squaring up before that. Now the longer term trend, I will remain bullish, and I think realistically, if anything, this is what I think. You never know, but I think when we open on Monday, on Tuesday, we'll probably see a bit more of a bullish bias, because I do think the infection numbers will come down a bit more. But you never know. I mean, the weather is nice already, and I think it's going to be like 24 degrees in London right now. The sun is shining. I had to close the blinds and everything here. So people might use that as a reason to go out, and maybe they'll pick up more infections. So we'll see. But I think overall, if it goes down to 10,257, then that's going to happen because of profit taking. It's the same what I said a few days ago. We're trading here, remember, and we said it was going to come down. People are going to buy, and hopefully they will do that again. And for now, I'm going to remain bullish above 9,997. The Financial Times, by the way, did some updates on their indicators for China. You need to be a subscriber to read that, so I'm not going to be able to share any charts from you, but you might be able to find them online. The Chinese economy is operating at 62% of its value from the beginning of the year. Typically, will be at 80% around this time of the year. So there's definitely that gap. So why is this that gap then? Well, firstly, people in China themselves are not consuming as before, but everybody else is in lockdown, so they're not really producing as much as they used to. But you have Czech Republic, Austria, Denmark, Norway, and then there was some other country, which I forgot, that are about to open up. And Austria should be opening up smaller shops already from Monday, I think Tuesday next week. And then they're going to open up a lot of bigger shopping malls and stuff, and so on and so on and so on. So things are going in the right direction, and that is why stock markets are going upwards. I did actually a longer update on this one here in investingq.com. This one here, you just need to be a member to sign in, and you can read it. And there you go. Do like that. Now, we just need to understand what I'm trading here as well, and what I'm looking at. So there's economic implications of all of this, no doubt. And the economic growth is not going to be as before. As I said, in China, they're in the beginning of the year, were 100%. Typically at this time of year, they are at 80% of their peak. However, they're at 60 or so now. So there's definitely going to be some changes. People are definitely going to lose jobs, as I said many times before. But what I think happened here is that the market went from being really, really bullish to being extremely bearish. And when we were down here, I was just saying that this market probably got it wrong. And then we went upwards. And we did go upwards. And because it's such volatile conditions here, you can make money on the downside and the upside. And remember, I was bearish on a technical basis for most of the way down. And we're up with 31%, which is not a small amount. And what I'm saying now, I think we can go a bit higher. But are we going to go all the way up to its prior high? Yes, we are. But not this year, maybe next year or the year afterwards. I definitely think we're going to go up because the government's pushing so much money into the system. Interest rates are super low. Like, it's ridiculous how little you pay in interest rates right now. So all of that's going to lift the economy and then stock markets in particular. So then we can go up. Again, we can do maybe correct 61% of what we had seen a sharp decline for here. So maybe go up. And then maybe here, maybe what's going to happen is they open up the economies, but at the same time, you know, the economies are not improving, and then you start to see adjustments and stuff like that. But even if we go up here, we're going to go back to levels we have seen in, let me see here. So we were down to 2013 level. So effectively, we lost 7 years in the German DAX. And even if we just go up to 61.8, we're pretty much at 2015 level. So again, I think there's a bit of a mismatch there to reality in stock markets. In the case of the S&P 500, we went down to 2016 lows. Now, if you remember, President Trump cut taxes in a big way. GDP has been strong. So we have all that growth, and obviously that's going to bounce back at one point, I think, as well. So is it fair that the market is going to be down here at 2016th low? Probably not. Here's the S&P 500, and the trend here is also bullish. So yesterday we said look to buy here in this little spot. The market did rise. We're now at the take profit area. So this is a good little spot to book profits if you haven't done so already. And if you want to reduce risk over the weekend, no one really knows. Everybody has different strategies as well. But there are some markets it's fine to hold on to positions. But this one, probably a little bit chance here to book a better profit. If we go down, we'll go down to 26,007 or 2672. And I think people are going to buy back here, stops here. Because I think volatility has changed as well. This is very typical. I mentioned to you several times. And what's happening here, have very, very volatile conditions. And then when the market starts to see the improvement ahead, volatility drops sharply. And then it becomes a bit of a boring market. In fact, let's take a look at the VIX. So this is the VIX index. So VIX index, okay. So it's actually dropped. It's difficult to say. I mean, it looks like it's going to bounce here from a purely technical perspective. Anyway, I don't think we're going to be able to use this right now. If we look at crude oil prices, so yesterday we said, or 2 days ago, we said look to buy here. 3 days ago, we said look to buy here. We did go down here. We were in a bit of profit. And then yesterday we tumbled. And then when we did the webinar, we said, you know, one could buy down here if you wanted to. And if you did buy down here, you would be having a residual ratio floating profit of about 2 times your risk. Now, because we moved up here and then the first position was a bad entry effectively, I have actually pushed down the buy spot to 25.14. So even if you did buy here, you would be in a bit of a profit now, and maybe this is just going to go upwards. But many times what happens is that when you almost get stepped out of a position, you will eventually get stopped out. And I can tell you that by being long here from 25.82 is not a good spot to be long from. Even though we might go upwards because the trend is upwards. So I'm going to continue to be bullish, but I want to be bullish from 25.14 and between 25.14 and 23.32. And I think we can go upwards. Gold prices. These are gold prices. So I had to lift up the buy spot today. And the reason for lifting the buy spot is that the price did not want to come down to where I wanted it to go down to. If it goes down to these levels and you're looking about this level is 1643, then I think people will be probably looking to buy in that little spot. As for currency markets, I'm putting them at the end of the presentation because there's not too much value, I think, focusing on these ones right now. And you know the story, Euro USD is just down a lot, up a lot, down a lot, up a lot, down a lot. And I think because risk in the world is coming down a little bit, people, cryptos are up, stock markets are up, people are less concerned right now. This can give the dollar a bit of a boost, the euro a bit of a boost, and I think we're making up to 110, maybe 111, but I don't have any strong view on this market. And I think it's prudent to focus on stuff that makes perfect sense right now, like stock markets. So the trend is going to be bullish above 10769, and I had to lift up the buy spot area to this level here. If we revisit it, some people are going to buy. If you look at this, it looks exactly like gold, and I prefer gold actually because it has more of a well-defined uptrend. I prefer gold rather than the euro at current levels. GBP versus the USD. So I had to push up this. I pushed up this. So a few days ago, we said look to buy here, right? And we're now at the take profit level that we talked about a few days ago. So we are at the take profit level. This is a good spot to book 100% of profits. What you do, of course, is up to you, but this is a good spot. It could, of course, be that we're going to take out this high and then when you go higher, but I think we can deal with that afterwards. If it does go up and then when it comes down, we can buy it again. If we look at things like the Aussie dollar and the New Zealand dollar, they're all quite bullish and sort of leading the way upwards. As again, people are starting to price in some sort of normality, some sort of back to how things were before. Now, if you look at this today, because effectively this is a good spot to book profits, the buy spot here is down here at 2308. Okay, that's where I would not like to buy, and trend defining level is going to be here. What's also good as well is that Prime Minister Boris Johnson is back up. Apparently he's now able to sit up. I think even stand. I think they said. I think it must have been sit up. So that's a nice improvement. This is actually quite interesting. There's a huge proportion of people around his age, and the PM is 55 years old, that actually end up in intensive care. However, the highest fatalities are actually in people that are older than 70, which is quite interesting data. But he's back up. That's good, because now there's been a lot of talk of who's gonna govern if he's sick and so on and so on, and it doesn't seem to be as straightforward, for example, as it is in many other countries. Like I know it's obviously a bit different, but you have your president in the US, and if things go bad, the vice president will be there, right, and can take action. So there's been a lot of talks and discussion about that, especially in the press, about what's going to happen if the PM can't come back to work. And it will probably take some time, because typically it will take a few weeks before you can come back after being on intensive care. We'll see what happens. Hopefully he will do fine. The market is liking it and pushing things upwards a bit. Dollar yen. Dollar yen is trading sideways, and much like the dollar, much like the Euro USD, but it's a bit conflicting here. On one end, I think if the world turns bad again and virus cases and all of that go bad, then we're probably going to go a bit lower. At the same time, you have a situation where if things really go bad, people just want to hold more dollars than Japanese yen. So this pushes things upwards here. So there's some conflicting forces here, and it's not really clear what's going to happen next. Let's take a look at cryptos as well. So you have Bitcoin, and Bitcoin is still on its way towards its target. So we have a target of 8,119. So this is an ascending triangle. We triggered that already. We tried to trigger it already on April 2nd, but it was first on April 6th that the market really was able to push higher. And in the very short term here, we're in another ascending triangle with a break to 7464, probably triggering that, and might happen now, might not happen never. But I think as long as we trade above 6584, I'll continue to be bullish, because the trend is going to continue to be bullish as long as you're above this level, and this pattern can still be priced in. And that's it. Let's see if you guys have any questions. Okay, so we have Stefan saying good morning, which we covered. Why does everyone think stock markets have bottomed when we haven't even begun the recession? The markets have never bottomed out before the actual recession begins since 1985. That's interesting. Yeah, that's interesting. However, though, and you might be right. You might be right. And I can tell you, not everybody thinks the bottom has moved. The bottom is kicked in. In fact, because I'm on Twitter, I don't post too much, but I see what other people are posting, and it's very difficult to find someone that is bullish. And I'm looking at these perma bears, they're sort of back into what they used to do before, which is just to be in pain and agony all the time, because they don't understand why the stock markets are going up now. Again, the gameplay is very, very normal. When the number of virus cases pick up, so when we had like 600 cases in China, that's when they locked down in China. But people had already been selling before that, and it was the same. When we had very, very small numbers of cases in the US, people started selling. And then now, when we had the highest daily growth change, they went back and buying. And now we're seeing the world from a virus perspective has improved, because we're not seeing that acceleration. And that is why stock markets are upwards. Now what's going to happen afterwards, we can have second round effects. Your local restaurant, the people that work there might not be able to consume as they did before, and so on and so on. And that creates a problem, of course. And again, if the shutdown is temporarily, then because of all the money that the government is pumping into it, the markets are now pricing in that we're going to be okay. And of course, if this extends for 6 months, a year, then yeah, definitely a lot of people are going to be bankrupt. So, but there's not going to be like that. There's going to be a situation where government says, okay, guys, we need to go back to work, even if the elderly population is going to die, because otherwise the effect on the economy is going to be too big. And then on the other hand, you have suicides sort of outstripping people that are dying because of the coronavirus. So you have that situation, which I think is a balance that actually favors the economy. The reason why we even have so a huge spread is just because they wanted to protect economies before the elderly population. And then some of them did not even believe in the risks involved. And also this recession is a bit different than before, because we went from having a good economy to a situation where governments just tell people to stay home. That was it. It wasn't a slow moving snowball chain effect thing. It was just a sudden exogenous shock. And if you look at statistics for the last 100 years or so, when you have these very strong declines like this, you tend to see a quite forceful snapback if you go back. Now, again, let's not get too sophisticated, because none of us here even have that long-term view. I think all of us are quite short-term. We just hold positions for a few days. So the flavor over the last few days has been sell, because the virus is going to sort of destroy the whole world, and we're going to go back to the Stone Age. And then we reached Stone Age levels, I guess. And then suddenly numbers start to improve, and then people say, oh, look, we're not going to sort of go to zero in the S&P 500. And that's what I was waiting for. And then we turned bullish, and we said buy here, and buy here, and that worked out fine. and then we'll see if we can ride us to the upside. But I'm sure when we come up here at these levels, then it doesn't really matter at one point how much good news is being priced in. They can open everything up, but then people are gonna say, oh, but what's gonna happen now? We need to see that the economy grows back in force. And if they don't show those tendency, then that's gonna be the flavor. That's gonna be the theme of the day. Then it's gonna be, well, we don't have infections, but the economy is damaged. But if you look at your charts right now, they're not pricing that in. I think the only time you start to get sell signals is if you start to do some Elliott wave analysis or something. That's when you start to get it. But from a purely trend following perspective, we are dealing with an uptrend now. And that's what I want to trade. And about the actual recession, I think what's going to happen here is that the government is going to go, okay, guys, go back to work now. And then that's it. They're doing that in Austria. So the economy will slowly come back. And what if they find a vaccine or a cure? I mean, everybody's pumping money into this one. If they find a cure from one day to another, this whole thing is just going to be here at 3,100. So it's all about the risk reward ratios in this situation as well. You had some excellent companies that were down with 40%. Solid companies that make money every year for the last 15 years or something like that. Solid companies, very low debt and stuff like that. That's stuff you want to own and give to your children or grandchildren in 50 years. So, well, actually not 50 years, but 20 years from now. And those stuff was cheap. And again, it's just about the risk reward ratio. And the risk reward ratio for now, I think, still favors the upside. So the thing is this, also global GDP will be negative for the first time since World War I. So if you knew that in the beginning of the year, you would have sold. And that's what people did. People with very good foresight in the beginning of the year, they sold because they said like, oh, hold on, the US economy is gonna come to a halt. Imagine that if you knew that in the beginning of the year, then you would have sold. And then when the market was down with 35%, you still would have booked profits. But the fact that we are having a recession in the global economy for the first time since World War II, that's old news. Everybody knows that. Everybody. My wife, for example, she's into finance, but she doesn't really keep up with things from that perspective. Even she was telling me, no, the market's going to go down. Like everybody knows that the market is going to go down. The more information comes from the top, people with very good foresight, or for example, people that have access to superior information, or even if you don't have superior information, imagine you run your local coffee shop or local restaurant, and you can see already there's less people in your shop because there's this virus in China, and then you read, oh, they locked down everything, and then you start to say, oh, maybe I should sell some of my stocks, and they start selling. You have people like myself that I was in Hong Kong when everything broke out, and I saw how people reacted there. I talked with people there because these guys lived through the 2003 SARS epidemic, and I got an indication that things were gonna not go so good. And then I looked at the daily growth change in cases in China, and I could see that we were gonna reach these levels. Just all these numbers that we had I had a bet. I know it's not a very tasteful bet, but I had a bet with a guy in the office that, and this was in early March, and I said that Italy is going to have more than 34,000 cases. And they're like, no way that's going to happen. A guy in the office thought that the UK was not going to have more than 200 cases. People are very bad at thinking in exponential growth rates. And just understanding that could help you a lot. So that's, if you had that foresight, you would have sold here. And if you did sold here, and if you sold individual names, the index itself is down with 35%. Some individual names, as I said, are down with 40%. Some really bad stocks are down like with 70%. Like Lufthansa, I think, is down with 70% or so. Airlines, massive hit. Now, even the guy that is very bearish, after like a 70% return, he's gonna book profits. And maybe that is what happened here. Because at one point, the risk reward ratio doesn't favor to be bearish. And again, this might come up, might here. It's not going to be as straightforward, but it's going to be up here potentially, where we start to see that negative input or negative view on the market again. My view right now is that people are still way too bearish. People sort of like, oh, why is it up with 30%? I didn't make any money. I think that's the feeling I see when I look on Twitter. This is a very good contrarian stuff. Trading markets is the flaw in all of you bears is that the markets have already discounted those bad news. And now we're going to make you dance. Yeah, I agree. Now we're seeing some short squeezes. And I think we can see a bit more of the short squeeze, and then we'll see what happens afterwards. Because we have Mauricio, good morning to you. Hope you're doing well. And we have True Investor asking about the euro yen. So let's take a look at the euro yen. By the way, guys, for any uncertainty that you'll feel when you trade, because we're always dealing with incomplete information. Give you an idea. So there's Stanley Druckenmiller, which is like a famous hedge fund trader or manager that used to trade with George Soros. And these guys back in the days, they had the data. Now we have weekly data. Now you can look at your TomTom data and see that traffic is down or in some parts of the world. So you have so much information now. Back in the old days, the data was like 3 months old. And you had no real-time data. How did they make money then? Because they were looking at the charts and allowing the charts to guide them. So they will look at how gold was doing, how bonds is doing, how currencies, look at everything. It's called intermarket analysis. And then they would look at Standard Druckenmiller in particular. He would look at how the different sectors of the US stock markets were doing. They will look at all of this and to get an indication of people buying healthcare stocks. Are they buying miners? Are they going into like blue chip or technology or whatever, you know? I don't follow this so much. I don't know all the sectors on top of my head. And from there, they would paint a picture. And then they would put up positions on. But they never knew exactly what was going to happen. And that's why they put a stop loss. And it's the same thing with me and everybody else. We're dealing with incomplete information. And that is why the stop losses go where they are. And that's why we're looking for good risk-reward ratios. And then we'll ride the wave. And most of the time, we're going to get it wrong. Definitely. But if you get it right, and when you get it right, you make good, decent profits, then you're cool. For the longer-term investor, it's an excellent time to be bullish stocks. We might go down to the lows. We might even drop a little bit more. But a little virus is not going to kill off us as a human species. And we all love to improve our lives, make more money and all that. And that is not going to be stopped by a virus. So longer term investors just need to sit tight. That's what I'm doing. And just keep on buying. Okay. Euro yen. Anyway, about what I just said, that's what I'm doing. What you do, of course, is up to you, right? Euro yen, what's going on here? So euro yen is just consolidating on this daily chart. And it's even consolidating within a more shorter term perspective. So there's not too much to say here. Markets don't know exactly if they should be bullish or bearish. That is what this chart is telling you. If you look at it from a bigger picture perspective, the trend is bearish. The euro overall is underperforming versus the Japanese yen. The Japanese yen overall, since sort of ever, tends to strengthen. You see here in 1977, it was at 237, and then it went down and down and down. And the reason for this is that inflation in Japan is really, really low. But since pretty much 1993, we're pretty much in this big pattern. And true invention, you're not going to have a lot of fun here because it's contracting even more. And at one point, we might have a big breakout. Don't worry, I'm going to go into the short-term charts. But this is interesting. So we should be breaking out here in 2003, maybe? Yeah, 2023. We usually break up before we hit the endpoints. If you look at it from a daily chart, again, the trend is short-term bearish. You got yourself a double bottom here, if not a triple bottom. So it's very straightforward from that perspective. If we take out the lows, we can probably go all the way down to this levels down here. So you're looking at 108.74. All right, that is what we're looking for. And in the shorter term, like 6-hour chart, we're unfortunately just trading sideways here, and we're in the middle of the range, which just makes it very, very, but it doesn't make it very sense to trade this. If you do want to hold a position on, and you happen to be very bearish as well, you think things will turn bad again sooner rather than later, then maybe you can look to be bearish from 120.18 and 121.46, which is this level up here. You could probably look for something like this. So that's one option. The other option is to again sell the break here, and that could potentially, it's gonna take some time. Look, this is September or October, November, all the way I mean, it's a few months of data here. So if we have a break, it's gonna take some time, but break to the downside makes sense. But there's other stuff you can watch. I think if you really want to be bearish, maybe you can look at Aussie dollar yen or something like that. So here the market, this is quite interesting actually. We're gonna wrap things up, by the way. So this is Aussie dollar yen, massive inverse head and shoulders. This is data from 2009, and you have left, right shoulder, and head. You get that neckline. That trigger here has a target of 46. And if you look at this in the short term, you're having a strong correction down. But from a weekly chart, as long as you're below this high, we're probably gonna go lower. And if we flip now to the daily chart, we're correcting. We almost at the 61.8% correction level. It's a little bit too early, I think, to turn really bullish here, or bearish, because I think it's kind of going to go down and up, and then we'll see what happens here over the next few weeks, and if we want to turn bearish or not. Okay, I think we're gonna wrap things up. Any thoughts on airlines in terms of investment? I think I'm probably not the right guy to ask about that. If you do want to buy into some airlines, the problem, for example, with Lufthansa, this should be this one. The problem with Lufthansa, by the way, look, is very, from its high here, it's down 72%. So the problem with Lufthansa is that it might be nationalized, or the German government is going to push equity into this, which means sometimes, at least what they've done in Sweden, which I think is fair, is that technically the company would have gone bankrupt anyway. So they put money into I'm not saying they would go bankrupt because I don't follow them too much, but the governments put money into that. And to put that money, they usually get shares back, unless it's a loan, which I think is a bad idea from governments, from people's perspective. So they become shareholders in that. And that means that if you're a buyer right now, some of your value is going to be wiped out. So you can have a significant loss just because the government comes up. Of course, eventually the stock would go up. So if you do want to invest in airlines, maybe what you should try to do is you try to look at different airlines across the world and see if there is an airline there that, you know, has very low debt, has good cash to survive the next 6 months, up to a year, and from there you could probably start to find something that makes sense. So something that is not going to be needing a bailout, because if you do get that bailout, you're gonna probably wipe out some of your stuff. There are different stuff. There's a bunch of stuff there. I think everybody knows something that is good, that it could be worthwhile investing in. I think I talked about this before with you guys. I'm not sure if I did that, but let me show you to you. So this is Kering. So Kering is the owner of Gucci and Yves Saint Laurent, and they have very, very good brands, and they sell shoes for £500, where they probably don't pay more than maybe £50 to create the shoe, I reckon. and their share price. And this is also cash cows. They make decent profits every year. And here you got a 43% decline. I was actually looking at this for my clients, and we said this is the time if you want to be bullish. And then market did indeed nicely go upwards with some solid 30%, actually went up higher. And these companies, I mean, I think I didn't do a full research, but I definitely know they're making money. I think there's a solid company. I don't think they have too much debt either. But some of these companies are so solid, and after the virus, people still gonna be able to want to buy like 500-pound shoes. So stuff like this makes sense, where you can buy these at some sort of a discount. You can also look into a sort of cruises and stuff like that. I'm sure nobody wants to go on a cruise right now, but in 2-3 years from now, people will like to go on cruise. But again, it's a little bit high risk, the cruise business. But there's other stuff like maybe some car makers, truck makers, shoe makers, fashion makers. There's different stuff. You just need to find those companies that are good if you want to do some direct investments in stocks. Okay, we're gonna wrap things up. Yeah, so we're gonna wrap things up. And if you do have any questions for me during the day, you have my Twitter on the very top. You can ping me. I'm not going to be able to tell you if you should be buying or selling something or give you direct trade advice. But if there's anything else, we do have some education and so on that could potentially help you. We do have also a trading course with ATFX that you can check out by following that link there. Have a great day, guys, and a good weekend. Friday bank holiday, Monday's bank holiday in the UK as well. So I'm going to be back on Tuesday for the next market update. Thanks so much, and I'll see you guys soon. Bye-bye.